Thank you for being here today, David.
Delighted to be here. Thanks for having me on. It's good to see you again.
Yeah, so this was almost 2 years ago. A lot has happened since then, but we'll start with you. So could you tell us about yourself and about your career?
Sure. Well, I've been in the industry. This year will be 36 years in the industry. Spent the first 30 years of that running operating mining companies, including Gold Corp, Hud Bay Minerals on the copper side. Before that, I was the CFO of Agnico Eagle for a long time as well. So really been involved in the construction and development of numerous mines, both on the copper and gold side over the course of my career. And I've pivoted now to running a royalty company, which we founded about 6 years ago and took public about 5 years ago now, and grown it from a $200 million market cap company to over $1 billion market cap on a fully diluted basis.
What would you say separates Gold Royalty from other royalty and streaming companies?
Well, I would say the diversity of our portfolio. We have over 250 royalties in our portfolio. We've grown that from 18 royalties to over 250 royalties in the 5 short years that we've been in operation. We now have 8 operating royalties. By the end of this decade, we'll have close to 20 operating royalties. There are a number of projects that are in construction and development that underpin 360% growth in our gold equivalent ounces over the next 5 years. So a really significant ramp up in free cash flow from a very broad portfolio of royalties. But importantly, the cornerstone of our royalty portfolio is represented by 3 of the 5 biggest producing gold mines in North America, namely Canadian Malartic in Quebec, the Côté mine in Ontario, and the underground extension of the Gold Strike mine in Nevada, which is called REN, operated by Nevada Gold Mines. So we have 3 generational assets with multiple decades of reserve life ahead of it that underpin that growth. So it's not just about a collection of small assets. There are some very large scale, long life assets that really will provide annuities for our shareholders for many decades to come.
Could you summarize? I guess start with if you could summarize the past year for Gold Royalty.
You look, it's been an auspicious year for us in that we saw quite significant growth in our revenues. So we had record revenues in each of the first 3 quarters that we've reported on in 2024. We exited the year with no debt on the balance sheet. We started the year with about $70 million of debt outstanding. And through the generation of free cash flow and also through an equity raise that we used to finance the acquisition of our Pedra Branca royalty in Brazil, we've now completely paid off our debt. We have, with cash on the balance sheet and available credit lines, now over $120 million of available cash and credit lines available for future growth with no debt on the balance sheet. And we pivoted for the first time in our history to positive free cash flow. So that helped pay down the debt, but also put us in a position to see increasing positive free cash flow over the course of the next 5 years. Because as I said, we're looking at 360% growth in gold equivalent ounces from an existing portfolio of royalties. And you won't see any commensurate growth in our operating costs. They're quite stable. They've actually come down over the last several years as we've realized post-merger integration synergies from the companies we rolled up over the course of 2021. And so our cash G&A costs are somewhere in the $7 to $8 million per year cash costs against, by the end of the decade, at current gold prices, well over $100 million of revenue. So that's a 90% plus margin business that we're growing into from the existing portfolio of royalties. And I should add that all of those royalties are bought and paid for. We have no capital calls, no installments due on them. So we're very much in a harvest phase right now. We've been building up and investing in the portfolio over the last 5 years. That's generated, again, a 14-fold increase in the number of royalties, but also delivered a lot of growth. But that growth is paid for now. And so really, our shareholders are now reaping the returns and the benefits from the significant investments we've made in very high-quality assets, predominantly in the Americas.
By the way, so that $90 to $100 million in revenue, what gold assumption is that based on by the end of this decade?
Yeah, so we're going to be exiting the decade with close to 30,000 gold equivalent ounces of production from the existing portfolio of royalties. So even if you use a round number of 4,000 gold, that would give you $120 million of revenue against $7 to $8 million of cash G&A costs. And I should add that all of our gold assets are complete, or the royalties, top line royalties, are NSR royalties. So they have no operating costs associated with them. They're not streams. So as the gold price goes up, our operating costs do not go up. Every dollar of incremental revenue as a result of gold price increases falls right to the bottom line for our shareholders in terms of positive free cash flow.
What's the current financial position and also access to debt?
So as I said, our line of credit is completely undrawn right now. We have a $100 million line of credit. We have no debt on the balance sheet. We have about $20 million in cash on the balance sheet currently. So we have available credit lines and cash of $120 million. But I should add that we're going to have significant positive free cash flow in 2026. So that will only grow over the course of this year, assuming we don't make any other growth investments.
Formal guidance is not out, but could you give some sense on the expected, gold equivalent production or revenue for this year?
Yeah, so if we look over a 5-year horizon, particularly when you incorporate Pedra Branca into our projections over the course of the next several years, because that adds in another 3,000 gold equivalent ounces of incremental production each and every year based on historical performance when BlackRock owned the royalty. We're looking to exit the decade with about 30,000 gold equivalent ounces, growing from about 5,000 gold equivalent ounces in 2025. And so that's, again, about 360% plus growth on a compounded basis over the next 5 years from the existing portfolio of royalties. We will provide more definitive guidance on the current year when we report our Q4 results later this quarter, Q1 of 2026.
And that growth to close to 30,000 ounces, how does the curve look like? Is there any year where you have a very steep, like a big royalty coming online, or could you give some sense?
Well, there are a number of royalties, and it's actually quite staged. And over the course of the next 5 years, we have steady growth each and every year in our gold equivalent production. So, for example, this year, Pedra Branca is new to the royalty portfolio. Côté will have its first full year of nameplate capacity production. It was a ramp-up year in 2025, so that's going to contribute to growth. Canadian Malartic is increasingly transitioning from open pit to underground operations over the course of the next couple of years, and that'll be a significant step change in our production profile there because we have much larger and broader royalty coverage on the underground than we do the open pit. So as we go underground, we have a 3% NSR royalty on about half of the underground resource, whereas we have a very small fraction of the open pit covered in our current royalty. So that will represent a big step change as well. Borborema just started production last year. 2026 will be its first full year of production. And they're also expected to announce a fairly significant expansion in production beyond that. So that will represent another step change in production within the next couple of years beyond the ramp up that we expect to see this year. So really there's quite a variety of new operations, expanding operations. Another one is Varus in Bosnia. It's a copper stream that we own on one of the largest silver mines in the world, operated by DPM. That is completing ramp up as well. DPM only took over the operation, which started up last year in the fourth quarter. And so they expect to be up to nameplate capacity later this year. So this year is still a ramp up year for them, and 2027 will represent another step change. And DPM has already said that they're looking at expansion opportunities there that we haven't incorporated in any of our guidance out in the 5 years. So there's a lot of optionality in the portfolio. But again, there's such a broad array of diversified royalties within our portfolio that are delivering growth each and every year, whether it's through the startup of operations, ramp-ups, expansions. There's so much optionality and growth in our portfolio as a result of the diversification we've been able to achieve over the last 5 years by steadily adding to the portfolio.
And what's the annual G&A spend, and how do you expect that to change?
Yeah, so it's about $7 to $8 million, and in fact has been coming steadily down. And that's because over the course of 2021, our first year as a public company, we rolled up 3 of our peer companies: Ely Royalties, Golden Valley Royalties, and Abitibi Royalties. And we had completely eliminated all of their G&A costs, but it took us a few years to do that, to realize those post-merger integration synergies and efficiencies. And so there was about $10 million of G&A that we completely vaporized as a result of the roll-up of those 3 companies. They're gone. So that's why we've seen a steady decline in our G&A costs over the last several years, even as some of our peers have seen their G&A costs go up. So we expect that $7 to $8 million to be sustainable for the foreseeable future. We haven't added any personnel. It's been the same footprint from a human resource standpoint almost from day one. And so we're in a position, given the scalability of our model, to add significantly to the portfolio over time without actually adding to our G&A costs.
Could you give us an overview of your most recent acquisition? 25% NSR gold royalty and 2% NSR copper royalty on the Pedra Branca mine in Brazil, and also justifies the price tag of 70 million USD.
Yeah, certainly. Well, just to give you a sense of what it's been producing for BlackRock since it started production about 5-6 years ago, it's been producing steadily about 3,000 gold equivalent ounces to BlackRock's account. And this is the BlackRock Trust. It's a publicly listed trust run by the BlackRock Fund in London. We bought it for $70 million. And so that 3,000 gold equivalent ounces at current gold prices would be over $12 million of revenue to our account going forward. So it's a very quick payback on that $70 million investment. By all estimates, we're looking at about 15% plus rate of return at current gold prices, but with significant expansion opportunities. BHP is the current operator, but they're selling it to a Turkish conglomerate called Corex. And Corex is likely to significantly reinvest back into that asset, both to extend mine life, but also look at opportunities to expand production. So we have optionality there, both from an exploration standpoint and also from an operating and expansion standpoint, but with a very long reserve life ahead of it, 15 years of reserves ahead of it. So you can see the rates of return are quite significant for us in the current metal price environment.
So what's the mine life? And if you look back at the production profile, do you think that is there any reason why if that would be different this year?
No, there's no reason. Actually, we expect, as I said, with a new operator coming in and looking for ways to realize expansion opportunities, exploration opportunities, we expect the current mine life of about 15 years could potentially be extended, which would afford the new operator, Corex, to look at opportunities to expand production.
You paid $70 million, you raised $103.5 million, so give or take $100 million as there are some transaction-related costs. Why and how do you plan on deploying that cash?
Yeah, so that cash is really, the extra cash and the sizing up of the equity raise is entirely a function of how well this acquisition was received in the market. We went to the market to raise the equity with a specific use of proceeds, which was to acquire the highly accretive Pedra Branca royalty. As I mentioned, very high rate of return. The market received it very well. As a result, we had oversized demand for the equity raise, so we upsized, anticipating that we may have future growth opportunities. So really that additional cash was put on the balance sheet. We were already debt-free as a result of the free cash flow we generated in the last year and the conversion of some in-the-money convertible debentures over the course of this year, which completely eliminated our debt. So again, it puts us in an enviable position of having that $20 million of incremental raise on the balance sheet with no debt and a $100 million credit line that's completely undrawn and available for future growth opportunities.
Could you give us an overview of your core royalties, both that are in production and that will come into production, and the outlook for them in the coming years?
Certainly. So as I mentioned, Canadian Malartic is probably the cornerstone asset. This is the one that's, I think, emblematic of gold royalty. It's also true to my roots. I spent 12 years of my career with Agnico Eagle operating in that region. And Agnico Eagle is, my former employer is the operator there. So again, organic to our skill set and our knowledge base. So a lot of institutional knowledge of that district from a geological and political risk standpoint. But that asset has been operating for 15 years as an open pit operation, is transitioning fully underground over the next couple of years with the addition of a $1.6 million shaft and underground infrastructure to convert from an open pit to underground operation. And we have 3% royalty coverage on about half of the underground resource there, which means that we're going to see quite a step change in our attributable gold equivalent ounces from that operation as it transitions underground. And there's still a lot of exploration potential at depth there, because as Agnico gains access for production with that underground infrastructure, they're also getting better access for exploration drilling, and they're adding significantly to the ounces there. So we're looking at least 30 years of reserve life from that operation from the underground. It's a massive, massive deposit in one of the best jurisdictions in the world, as judged by the Fraser Institute for mineral potential, low political risk, and low regulatory risk. Also, Cote in Ontario, which is IAMGOLD's most significant operation, it came into production in 2024. And as a result of the ramp up last year, we've seen quite a ramp up in our royalty revenue there. And this will be the first steady year of production at nameplate capacity in 2026. So that'll represent a significant source of growth in 2026 from what is already a very long reserve life, 20 to 30 years of reserves. without the benefit of significant exploration drilling. That was just based on the initial delineated resource that formed the foundation of the initial study to bring that into production by IAMGOLD a couple of years ago. And then Ren is the underground extension of Goldstrike. We have both a 1.5% NSR royalty and a 3.5% net profits interest royalty on that underground resource. And it is coming into production later this year. Barrick is already putting 2 twin tunnels into the deposit. It's a 2 million ounce resource with a 7 gram a ton grade relative to sub 1 gram a ton that they're mining from the open pit currently. So as a result of the surface infrastructure that's been in place there for decades, they're going to be able to bring that into the mine plan very quickly as they gain access and incorporate it into the block model. So by late this year, they start production. Next year, they expect to contribute about 140,000 ounces of production per annum. And we have a 1.5% NSR on that production. So that will contribute to our revenue starting next year. So those are the foundational assets within the portfolio. But as I mentioned, we brought in a copper stream on the Varus mine, which is an 18-year reserve life, one of the 10 largest silver mines in the world. We have 100% of the copper streamed off from that deposit to our account. And that's already contributed meaningful revenue to us in 2025 and in 2026 as it achieves nameplate capacity. That will only continue to ramp up production. Borborema started production last year. It's a gold mine in Brazil. And we have a royalty on that, 2% NSR royalty. It's producing about 80,000 ounces of gold per year. And it's already been contributing revenue to us as it's achieved commercial production in the fourth quarter of last year. And Aura Minerals, the operator, is already contemplating a doubling of the production rate as they incorporate a significant growth in the resources there since they started up operation. So those are some of the more significant assets in the portfolio. With over 250 royalties, you can imagine there's a lot of optionality and growth embedded into that royalty portfolio. And because it's completely bought and paid for, that's free optionality for our shareholders.
Precious metals prices are very strong. Copper price, the price is also very strong. What's your view on where we are in the commodities cycle? And that might vary from metal to metal, but if you could give your view on that.
Yeah, well, we can start with gold. I mean, over 90% of our exposure is in gold in terms of our royalty portfolio. We have a nice copper kicker. About 10% of our exposure is in copper as a result of the Varus and also the Pedra Branca royalty, which has partial copper coverage as well. And so we do have a lot of copper exposure as well. And I would say on the gold side, really what's driving the gold prices is the fact that there's no opportunity cost owning gold right now. I would argue that sovereign debt is yielding negative on a real basis when you factor in where inflation really is. Interest rates are still quite low, but I would say inflation exceeds where short to medium term interest rates are. So as a result, there's no opportunity cost to owning gold as opposed to owning, for example, US treasuries. And we're seeing central banks globally and now some stablecoin funds start to increasingly deploy capital away from treasuries into physical gold because it's the one currency that can't be debased. And certainly there's a competitive debasement of fiat currencies that's occurring across the Western world as we're seeing increasing money supply to counteract significant amounts of debt that we're seeing at the sovereign level. There's no fiscally responsible way to repay that debt. So the only way to repay the debt or deal with the debt is to debase the debt. And that means debasing the underlying currency. And so I think everybody understands that dynamic, whether you're central banks or whether you're individual investors that have significant net worth. You're looking at gold as an important diversifier to protect the purchasing power of your savings. And we've seen that over a very long time horizon. When you go back to when we abandoned the gold standard in the early 1970s to today, gold's gone from $35 an ounce in the early 1970s to almost $4,500 an ounce today. And the purchasing power of most Western currencies has declined by about 99% over that period of time. So there's a significant correlation or negative correlation between the purchasing power of fiat currencies and gold. Gold is the ultimate currency and it can't be debased, can't be printed. And there's a decreasing amount of supplies being introduced by mining in the space because of the lack of investment and exploration. So I think the fundamentals for gold are solid as long as we maintain that easy monetary stance that we're seeing across central banks in the Western world. When you look at copper, that's very much a demand supply driven dynamic, unlike gold. Gold is a currency, whereas copper is a commodity that has significant industrial usage. And that is really in the decarbonizing effort that we're still trying to undertake globally in our economies. And copper is intensively used in electric vehicles and our electric grids. And so we need increasing amounts, almost exponential increases in supply to meet the demand that our global economy requires to decarbonize. And frankly, the supply just hasn't been there. Like gold, we've seen significant underinvestment in exploration as a result of the lack of access to capital for the junior explorers in our industry over the last 15 years. And so that means there isn't this pipeline of new projects under development to meet the demand requirements that we have in our general economy. So I think that the fact that we haven't seen a supply side response in copper means that we're not near the incentive level of pricing that we need to stimulate new supply. So that means copper needs to be considerably higher than where it is today, even though it is at record levels, to stimulate the supply that our general economy requires.
What are your key capital allocation priorities?
Well, right now, I would say we continue to look for new growth opportunities, but we're at that point where we're generating steadily increasing free cash flow. So we are going to have a discussion with our board over the course of the next year or so about returns of capital to shareholders. And whether that's in terms of a steady dividend, an increasing dividend over time as our cash flow growth, or looking at share buybacks if it makes sense for us to do that. But returning capital in some form is definitely on the horizon for us. And hopefully we'll be able to discuss that within the next year or so.
Excellent. And you adopted earlier this fall, or last fall, I guess, a shareholder rights plan in the event of a unsolicited takeover bid. Could you add some color on that?
Yeah, look, there is an increasing theme around consolidation in our sector, and we've seen the introduction of new capital. Tether has come into the space and taken a significant holding of Elemental. They took over EMX recently. They've taken stakes in ourselves and Metalla and Versamet as well. Those are all, signals that consolidation is likely to happen. We want to ensure that our shareholders have an opportunity to get full value if somebody does want to take us over, and that we are able to run a rational process. We don't see a takeover on the horizon, but clearly Tether's introducing a lot of new capital into the sector. It's likely to support consolidation, and we want to make sure that there isn't a creeping takeover at no premium for our shareholders, because if you look at our growth, it deserves a much larger valuation, much higher valuation than we're currently experiencing, given the quality of our assets, the location of our assets, and lowest geopolitical risk jurisdictions, longevity of our assets, the growth, as I said, 360% growth in gold equivalent ounces over the next 5 years, as forecast by our operators. That means that there's so much value embedded into the portfolio. We certainly didn't want anybody to steal the company at no premium. So we want to make sure that if somebody does get aggressive, that we have an opportunity to run a rational process to get maximum value for our shareholders.
I mean, you're looking for anything that, creates shareholder value, but could you give some more color on what type of royalty or stream transactions that you're looking for, in terms of, what's the size range, metals, jurisdiction, and development versus producing royalties and streams?
Yeah, I would say more of the same. We're still very much gold focused. We do look at copper, gold porphyries, and gold bearing VMS deposits, because those are organic to our skill sets. If you look at what we've built as a board of management when we were previously operators, those are the type of deposits we built, whether it's the LaRonde mine in northwestern Quebec, Lapa, Goldex, whether it's the Lalor mine in northern Manitoba when I was running Hud Bay, another gold-bearing VMS like LaRonde, whether it's the Constancia mine in Peru that we built when I was running Hud Bay as well, a large copper gold porphyry. If we have some diversification as a result of buying royalties and streams and those diversified gold-focused assets, then we're comfortable taking on a bit more diversification, but we'll always focus on precious metals primarily. But in those polymetallic settings, sometimes we get some very attractive metals that have great fundamentals that underpin our growth. And we've done that. We've had a little bit of diversification as a result of focusing on those geological settings that are organic to our skill set. And so I would say geographies, you're always going to see us stay in relatively low political risk jurisdictions, because at the end of the day, a royalty company is a collection of contracts. And if we don't have confidence in the enforceability of those contracts and a judicial framework around enforceability, then we won't go into those jurisdictions. And so you won't see us take significant political risk. So I'd say more of the same. We're actively looking. We always have. We've looked at probably 2 to 3 new opportunities per month. We've only executed on 2 new royalties in the last 2 years. That means we're quite choosy. We're quite selective about what royalties we do. And we're selective in terms of the rate of return. If it doesn't meet our return criteria and somebody else is willing to pay more for it, then we'll let it pass. And so it's not like we're not trying. We are trying, but we want to be extremely disciplined in terms of the rate of returns that we generate in these royalties. And if somebody's willing to take a lower rate of return, then we'll move on to the next opportunity.
Perfect. And I mean, if you look back your past transactions, you have been in the sort of at least in the sort of between 30 to up to call it slight sub 100 million USD more transaction value. Now that you have gotten larger, you have depth for would you say that is still the range that you're playing in terms of size?
Yeah, we'll do small deals, and we have done some small deals before. $2-3 million deals if it introduces a high quality asset. For example, we took a royalty on Stiller Gold's Garrison project early last year for a couple of $1 million. That has near-term optionality, a significant resource there, high grade, in a good jurisdiction. And then we did the $70 million Pedra Branca deal at the end of the year. So we have looked at a fairly broad spectrum of royalty opportunities from anywhere from $2 million to $100 million would be kind of our sweet spot. We did the acquisition of the Vares copper stream for $50 million a year and a half ago. So again, it's in that kind of $0 to $100 million range is probably our sweet spot. And as I said, we have over $120 million of available cash and credit lines with absolutely no debt on the balance sheet.
And you talked about consolidation and M&A in the royalty space. Do you view it as more likely that you're an acquirer or being acquired?
We think we're an acquirer. We hope to be. And if you look at our history since we IPO'd back in March of 2021, that's exactly what we did. We pioneered the consolidation of the small cap space. Nobody was doing consolidation until we came onto the scene in March of 2021. And in 9 months, we rolled up 3 companies: Ely Royalties, Golden Valley, and Abitibi Royalties. So if you look at the pedigree of our management and board, we have collectively over 400 years of industry experience within a very small group of people, including our board is about 18 people. So it's not a lot of people that bring that wealth of experience. And it's not only operating and mine development experience, but also a lot of transactional experience. Our CFO and our head of corporate development are both very experienced, multi-decades of experience investment bankers in the space, leading mining groups at Bank of America and UBS before they joined us. So we have quite a bit of experience, both in terms of evaluating opportunities because of our development and mine operating experience, but also that transactional experience that comes from investment banking within our management team. So it's an enviable track record and enviable skill set within our team that really is equipped to run a much larger company.
Awesome. So with that, where do you envision Gold Royalty in 2 years from now?
Well, where I'd like to see us in 2 to 5 years is in that $5 to $10 billion market cap range, which I like to call the Goldilocks zone. That's where you're big enough to be relevant to large-scale institutional investors, but still small enough to grow. Because as good as the large cap players in our space are, and Wheaton and Franco and Royal Gold are excellent companies, well-run, great management teams, great assets, they are so large, it's really virtually impossible for them to grow in the current mining environment, given the lack of new development going on. So they'll continue to be juggernauts in our space, but they can't offer growth. If we can offer scale and growth, we think that has the potential to generate a much higher multiple than even the seniors, because you're investable. And with growth, you should get a premium to the seniors who don't have that kind of growth embedded in their portfolios.